Hello, welcome to the Economic View. I'm joined as always by Evan Lucas, our Chief Market Strategist. Hi, Evan.
Hello, Tony. How are you?
Yeah, very good. Look, we really have to talk about what happened yesterday, which was not a lot, but with the Reserve Bank once again keeping rates on hold. I suppose the milestone was that it's 2 years since anything has really happened with official interest rates at all. The Reserve Bank is not in a hurry to do anything. But what was your take, Evan?
That's an understatement. Exactly that. I mean, we've now had exactly 2 years. So August 2016 is the last time they moved rates. If you look at the market pricing in terms of where the market is now predicting, so all the economists and the actual interbank markets, their expectation of any chance of a rate movement now is actually out to 2020. So we could actually be sitting here for another 24 months and not actually be talking about an official cash rate move.
I guess the big question is, Evan, why would they move anything now? I mean, nothing is really changing in terms of the economy, although you could say that the labour market is stronger now. There's a few reasons, but inflation's still within that 3% band.
Oh, yeah, I want to go slightly different, right,
Yep.
in terms of, I agree. So yes, they don't have to lean against the wind like they used to with regards to the housing market. The housing market has cooled, obviously, in Sydney and Melbourne, particularly in New South Wales and Victoria. We know that, so the pressure and the froth in the market is not there, and inflation is below their mandate. What the thing though is, and this is where the caveat comes, this is where the interesting sort of debate now happens, is that is there actually ever going to be a scenario perfect enough for them to raise rates? Because that's what they want to do. We know that. We know that they want to get to inflation. They want to actually see it increase and blah, blah, blah. Are they ever going to see that happen? Now, the reason I've raised that is the Bank of England is actually now a really interesting sort of case in point against that argument. And what I mean by that is last week, they raised their official interest rates for the second time in the post-Brexit world. But if you read their statement, they are very, very nervous about Brexit. They are clearly saying that they are unsure about how this plays out and that there is clearly some form of pear-shaped ability to go ahead if Westminster particularly doesn't get on with it and find some form of deal. And they've got that till October. They also forecast GDP in the UK of 1.75% and inflation around 2% over the forward estimates. Now, you compare that to us, which is around 3% for GDP and around 2%. Now, we'll come to a little bit more of that in a minute, but they are saying that we are never going to find the scenario to find perfect rate movements, so we're going now. Now, the argument would be is they're giving themselves a buffer for if Brexit does indeed go pear-shaped, and they also have a scenario where their inflation's actually slightly moving ahead, whereas ours is basically holding true. But in saying that, the argument is there ever going to be a scenario where the RBA can move rates? And there's still also an argument possibly even for a rate cut. But all of that being where it is, that also suggests that the RBA is completely not only out of the market, it can't control it. And therefore, the Australian housing market, the Australian interest rate market is at the whim of global markets rather than actually by the RBA controlling it.
Yeah, I mean, if you have a look at it, we obviously never came down as far as they did in the US and Europe. Correct. In terms of moving to negative rates. So one could argue that our rates might have needed to come down even further. But then again, you know, the big concern at the time was the housing market getting out of control. Mm-hmm. Now the housing market is correcting without any force of change in official rates, even though banks and other lenders have been increasing their rates anyway outside of the Reserve Bank. And that's also a big factor,
correct.
Isn't it?
And what will be interesting now on that point is we are starting to see the banks either reporting full year numbers in CBA, and we've seen that happen already. Next week, and I'm sure we'll talk about it, the other three do their quarterly updates. And there are signs of slowdown. So CBA actually did show that they lost about 0.4 of 1% of their loan book, and that there is definitely a shift in their funding mix, definitely a shift in the loans that they have. So that's something to watch. It therefore also brings into Friday and the statement of monetary policy, because I also want to talk about that. Getting back to the whole point is the other thing that came out of the statement yesterday is that the RBA actually believes inflation in 2018 will probably ease off because of the housing market. They're actually very clearly saying that they believe that it'll be softer in 2018, but will pick up in 2019-20. So you'd expect to see that in the numbers on Friday. The other thing that they are probably also going to allude to is that they see GDP stronger this year, but probably easing off in 2019-20. So that is also a bit of a shift, is that again, if they do downgrade inflation look for this year, that'll push expectations even further back. So as I said, record already, 24 months been, August 2020, it could even be, we're still talking about 1.5% rates, if that is indeed what happens, because the market will price that in.
One of the factors which has been talked about in terms of the overall economy is commodity prices and demand. That has been coming off in many sort of areas where Australia is a strong producer of those commodities, copper, iron ore, base metals, those types of things. What sort of impact is that likely to have?
Yeah, I think the best way to sort of explain that is have a look at this chart on screen. This is the copper chart over probably the last 3 to 5 months, and you're right, copper's had a really torrid time. Doesn't matter where you look at it, CME, LME, or into Shanghai. There's probably twofold to it. Clearly, the part of the reason why copper particularly is sliding so quickly, they call it Dr. Copper for a reason, and that is that it is a very good indicator of industrial production in places like China and the US. And the Chinese trade war is clearly what you can see on that chart is pushing that. So when that really ramped up at the start of June, copper fell 15% and fell quite rapidly across all of the main contracts. It has bounced, and I think that needs to be probably put out there, but it will therefore mean that if you look at there will be a slight impact on the trade balance, or despite the fact that iron ore and coal are still doing incredibly well and probably will soak it up, and you may even also see that on the energy side. It is a forward-looking warning sign, is that if copper does hold off and doesn't return back to sort of even recuperate half of that loss, that would also suggest the market, yes, maybe overreacted to the trade wars, but believes that growth in 2019 and 20 is probably going to slow anyway.
Yeah, so we're not likely to see sort of any quick sort of issue with commodity prices coming off in terms of how that flows through the economy.
Yeah, that's true. And look, what's been quite amazing is the resilience, particularly of the iron ore price. The iron ore price has completely bucked all of the base metals. Base metals have had a horrible quarter and have started the third quarter in sort of similar fashion as we just spoke about. Iron ore's holding, and that's quite interesting, at about 67 to as high as 72 US a tonne. And you're starting to see that come through in the numbers that we've got. But again, it's the longer-term sustainability is the question. And again, the Chinese story will therefore play out on that, and we are always beholden to, if they do drop off on the iron ore story, and you will normally see that in December on cyclicality anyway, that may be another sort of trigger.
Yeah, and iron ore is very much a grading story as well, which we wrote about last week. The Chinese and others are after the higher grade material, and a lot of Australian iron ore producers aren't up to that level. So it's interesting factors in that market as well.
True. The big thing is the two big ones are, and that's the caveat also, is that you're right, the smaller ones that have gone by the wayside are because they are producing ferrous content under 62%, whereas your Rios and your BHPs monster them, and they even have 65% and 68%. So they don't get a haircut, they actually get a premium, and there is that huge gap. So yeah, I would agree. It's an interesting scenario. Iron ore will always be what it is. The longer term view though is again, if copper plays out the way it is, that may actually be a signal in itself.
Yeah, well, thanks very much, Evan.
Thanks, Tony.
Thanks for joining us on The Economic View.